and we're going to get into it. 2023 ended up being a great year, so we're going to get that out there right now. Very good year in capital markets. As we like to say, it's not how you start, it's how you finish. While the markets finished on a significant rally, it almost made you forget that we had 3 bank failures.
Right.
Most prominent Silicon Valley Bank. The 2 themes that I talked about were what drove capital markets were artificial intelligence and interest rates. If you could claim the mantle of having the most direct exposure to artificial intelligence, the Magnificent 7 stocks. If you were to add up the market capitalization of the Magnificent 7, and to review, that is Tesla, Nvidia, Microsoft, Apple, Amazon, Google, and Meta.
Yep.
So Meta is Facebook. Those 7 stocks, a little bit over $12 trillion as of yesterday-ish, kind of give or take. The market cap of those 7 stocks is bigger than the market capitalization of the equity markets in the United Kingdom, so Great Britain, England, Canada, and Japan. Those 7 stocks disproportionately, they were in the haves category. And then there were the have-nots. And if the haves could claim the mantle of having the artificial intelligence, the most direct exposure, the have-nots, well, they didn't have that. But what they did have in spades was exposure to interest rates.
Right. What we saw change in Q4, specifically the last 45 days, was U.S. large caps continued to still do well, but what we saw was U.S. small caps specifically and some other asset classes started to play catch up. And those last 45 days, I think, the U.S. small caps were up 18%, while U.S. large caps were up 8%.
That delta is something that we typically hadn't seen, right? It just had been, large caps all day, every day. Mm-hmm. And if you squeaked out a positive return in the other asset classes and you held a diversified portfolio, it was kind of like this moral victory. If you believe in the adage of kind of buy low, sell high, or at least in the case of, I think what we're telling clients is maintain your large cap exposure. Yeah. But the next incremental dollar of capital, we want to go
U.S. small caps, mid caps, maybe international developed.
Maybe a little bit of value. I think value strategies just in general have lagged. Patience and resilience. Patience to really stick with a diversified asset allocation. And I think the resilience to hold a diversified portfolio, to hold intermediate term bonds, knowing that the short term, the first 9 months of the year might have been difficult,
right?
But that interest rates were likely peaking and were going to roll over, and you wanted to have that exposure because you never know. A big significant chunk of the portfolio was flat to modestly negative to being positive, and that had a really big impact on returns. So I think patience and resilience, and I think those 2 themes are going to take us into 2024.
Right. Yeah. I think it could have been extremely tempting, especially in the first 9 months of the year, just to roll over into the top 7 stocks. That's what's working, and that's what's going to continue to work. At least that's what you might have thought. But I got to give a lot of credit to holding a diversified portfolio, and because in the long run, we like to think, a diversified portfolio that gives you exposure to both stocks, bonds, international, domestic is going to really drive performance over the long term moving forward.